The financial system is about to experience something we haven't seen in over 50 years. And if you're not prepared, the next 30 days could determine whether you preserve your wealth or watch it evaporate. Right now, as you're watching this, central banks around the world are making moves that would have been unthinkable just a few years ago. They're not just buying gold anymore. They're hoarding it, and the pace has accelerated to levels that should terrify anyone holding significant cash positions. Let me show you what's really happening behind the scenes. The Federal Reserve just held rates steady, but that's not the story. The story is what they're not saying. In their latest meeting, they acknowledged something crucial. Inflation isn't going away as easily as they hoped. And with new economic policies on the horizon, including potential tariffs and trade restructuring, the pressure on the dollar is about to intensify. But here's where it gets interesting. While the Fed talks about fighting inflation, gold just hit a lifetime high. Not because of speculation, not because of retail investors piling in, because institutions know something the average person doesn't. Think about this for a moment. Gold doesn't pay dividends, it doesn't generate cash flow, it just sits there. So why would the smartest money in the world be accumulating it at record prices? What do they see coming that makes paying premium prices for an inert metal the rational choice? The answer lies in understanding what's happening to the global monetary system right now. For decades, the world operated on a simple premise. The US dollar was the reserve currency, and everyone played by those rules. Countries held dollars, they traded in dollars, they priced commodities in dollars. It was the foundation of global commerce. That foundation is cracking. BRICS nations aren't just talking about alternatives anymore. They're building them. New payment systems, new trade agreements, new currency arrangements that bypass the dollar entirely. And every time they take another step, the demand for dollars as a reserve asset diminishes just a little bit more. Now, you might think this is a slow process, something that will take decades to play out. And you'd be wrong. The velocity of change in the monetary system is accelerating. What took years in previous transitions is now happening in months. And the next 30 days represent a critical inflection point. Here's why. We're entering a period where multiple forces are converging simultaneously. New leadership bringing new economic policies, central banks reassessing their strategies, geopolitical tensions creating uncertainty, and underneath it all, a debt burden that has grown so massive that traditional solutions no longer work. The U.S. national debt is approaching levels that make servicing it increasingly difficult. Every percentage point increase in interest rates adds hundreds of billions to the annual interest expense. And that money has to come from somewhere. Historically, when governments face this situation, they have three choices: default, austerity, or inflation. Default destroys credibility. Austerity is politically impossible. That leaves inflation. And inflation is exactly what destroys the purchasing power of cash and bonds while driving real assets like gold and silver to new highs. But let's get specific about what's happening right now in the precious metals markets, because this is where the story gets really interesting. The gold market isn't just rising on sentiment, it's rising on actual physical demand that's overwhelming available supply. Central banks added over 1,000 tons to their reserves recently, and that's just the official numbers. The unofficial accumulation is likely much higher. China, for instance, reports their gold purchases monthly. But analysts who track import data and refinery flows believe the actual accumulation is significantly larger than what's officially disclosed. Why would they underreport? Because announcing massive gold purchases would signal to the world that they're preparing for a monetary system change. And they're not alone. India, Turkey, Poland, Singapore, and dozens of other nations are building their gold reserves at the fastest pace in modern history. These aren't random decisions. These are coordinated strategies by sophisticated institutions that have access to information and analysis that most people never see. Now let's talk about silver for a moment, because what's happening in the silver market might be even more dramatic than gold. Silver has a unique characteristic that makes it different from every other precious metal. It's both a monetary metal and an industrial metal. And right now, both sides of that equation are screaming higher prices. On the monetary side, silver has always been gold's little brother. When gold moves, silver eventually follows, usually with more volatility. The gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has historically averaged around 60 to 1. Right now, it's been fluctuating in a range that suggests silver is undervalued relative to gold, but the industrial side is where things get really interesting. Silver is essential for solar panels, electric vehicles, 5G infrastructure, and countless other technologies that are experiencing explosive growth. And unlike gold, which is mostly recycled, silver gets consumed in industrial applications. Once it's used in a solar panel or electronic component, it's essentially gone from the market. The math here is simple but powerful. Industrial demand is rising. Investment demand is rising. But supply is relatively fixed. Mine production can't increase quickly because it takes years to bring new mines online. And most silver comes as a byproduct of other mining operations, so you can't just decide to produce more silver. This creates a supply deficit. And supply deficits in commodities markets lead to price spikes. Some analysts are projecting silver could reach triple digits in the coming years. Not because of speculation, but because of fundamental supply and demand imbalances that can't be resolved quickly. Now, I want to take a brief moment here because this is important for anyone watching who has significant retirement savings. If you're sitting on $100,000 or more in traditional retirement accounts, you might want to look into how gold IRAs work. I put together a free guide that covers the mechanics, the tax implications, and how to get physical precious metals into your retirement account without penalties. It's in the description below. No pressure, just information that might be relevant to your situation. All right, back to what's happening in the markets. Let's talk about the mechanics of how gold and silver prices are actually determined, because understanding this reveals why we might be on the verge of a major price reset. Most people think gold and silver prices are set by supply and demand for physical metal, but that's not quite accurate. Prices are primarily determined in the futures markets, where paper contracts representing gold and silver trade in massive volumes. On the COMEX, the major futures exchange for precious metals, the amount of paper gold and silver traded daily dwarfs the amount of physical metal that actually exists. This creates a situation where price discovery happens in a market that's largely disconnected from physical reality. Here's where it gets problematic. These paper markets work fine as long as most participants are willing to settle in cash rather than demanding physical delivery. But what happens when that changes? What happens when buyers start demanding actual metal instead of accepting cash settlement? We've seen glimpses of this already. During certain periods of stress, premiums for physical metal have spiked well above the paper price. Dealers run out of inventory. Mints can't keep up with demand. And the disconnect between paper and physical becomes obvious. Now imagine this happening on a larger scale. Imagine a scenario where major institutions start demanding physical delivery in size. The COMEX has rules that allow them to settle in cash if they can't deliver metal. But what does that do to confidence in the paper market? This is the scenario that keeps precious metals analysts up at night. Not because they're hoping for chaos, but because the mathematical reality of the situation suggests it's increasingly likely. The amount of claims on physical gold and silver far exceeds the amount of metal available for delivery. It's a fractional reserve system, similar to banking. And like banking, it works until it doesn't. Let me give you a historical parallel that might help illustrate where we are. In the early 1970s, the United States faced a similar situation with gold. Foreign governments held dollars that were supposedly redeemable for gold at $35 per ounce. But the amount of dollars in circulation far exceeded the gold available to back them. France, under President Charles de Gaulle, figured this out. They started demanding gold for their dollars. Other countries began to follow, and the U.S. faced a choice: deplete the gold reserves or change the rules. They changed the rules. President Nixon closed the gold window, ending the convertibility of dollars to gold. And within a decade, gold had risen from $35 to over $800 per ounce. We're in a similar situation now, just with different mechanics. The paper markets for gold and silver have created claims on metal that exceed available supply. And as more participants recognize this, the pressure for physical delivery increases. The next 30 days matter because we're entering a period of heightened uncertainty. New policies, potential tariffs, trade tensions, central bank decisions, Any of these could be the catalyst that triggers a rush for physical metal. And once that rush starts, it feeds on itself. Higher prices attract attention. Attention brings new buyers. New buyers increase demand. Increased demand pushes prices higher. It's a feedback loop that can move prices much faster than most people expect. Let's look at what happened in 2008 as another example. When the financial crisis hit, gold was trading around $800 per ounce. Within 3 years, it had more than doubled to over $1,900. Silver went from $9 to nearly $50 in the same period. Why? Because people lost faith in the financial system and sought safety in tangible assets. The same dynamic that's building now. But here's what's different this time. In 2008, central banks were still selling gold. They viewed it as a relic. Now they're buying it aggressively. That's a fundamental shift in how the smartest institutions in the world view monetary risk. When central banks buy gold, they're essentially voting no confidence in the current monetary system. They're preparing for a different future. And they're doing it with your tax dollars, by the way, which should tell you something about who benefits from these transitions. Now let's talk about what this means for different types of investors. If you're young and have decades until retirement, you have time to ride out volatility, but you also have time to benefit from a major repricing of precious metals. A position in gold and silver now could be worth multiples of its current value by the time you retire. If you're closer to retirement or already retired, the calculus is different. You need to preserve what you've built. And preservation in an inflationary environment means holding assets that maintain purchasing power. Gold and silver have done that for thousands of years. If you're somewhere in the middle, you're balancing growth and protection. And that's where a strategic allocation to precious metals makes sense. Not as speculation, but as insurance against monetary instability. The key is understanding that this isn't about getting rich quick. It's about recognizing a major shift in the global monetary system and positioning accordingly. Think about the people who saw the housing bubble in 2006. They were called crazy, pessimistic, fearmongers, until they were proven right. And the people who listened to them preserved their wealth, while others lost everything. We're in a similar moment now. The signs are there for anyone willing to look. Record central bank buying, supply deficits, monetary instability, geopolitical tensions, debt levels that can't be sustained, all pointing in the same direction. The question isn't whether precious metals will rise. The question is how much and how fast. Some analysts are projecting gold could reach $5,000 per ounce within the next few years. Others think that's conservative and see $6,000 or $7,000 as more likely. For silver, projections range from $100 to several $100s per ounce. These aren't wild guesses. They're based on historical precedents, supply and demand fundamentals, and monetary dynamics that are playing out in real time. But here's what you need to understand about timing. Markets don't move in straight lines. There will be pullbacks. There will be periods of consolidation. There will be moments when it seems like the thesis is wrong. That's normal. That's how markets work. The people who succeed in these transitions are the ones who understand the big picture and don't get shaken out by short-term volatility. They're the ones who recognize that a major repricing event doesn't happen overnight. But when it does happen, it happens faster than most people can react. And that's why the next 30 days matter. We're entering a period where multiple catalysts could trigger the next leg higher. Policy announcements, economic data, geopolitical events. Any of these could be the spark. And once gold breaks through key resistance levels and stays there, it attracts a new wave of buyers. Institutional money that's been sitting on the sidelines, retail investors who finally pay attention, momentum traders who pile in. All of that buying pressure compounds. Silver tends to lag gold initially, then catch up with explosive moves. So if gold breaks out first, watch silver closely. The moves in silver can be much more dramatic because it's a smaller market with less liquidity. Now, let's address the elephant in the room. What if this analysis is wrong? What if gold and silver don't rise? What if the monetary system muddles through? That's always possible. Markets are complex systems with countless variables. No one can predict the future with certainty. But here's the thing about precious metals as insurance. If you're wrong and they don't rise dramatically, You still own tangible assets with thousands of years of history as stores of value. You haven't lost everything. You've just underperformed other investments. But if you're right and the monetary system experiences a major reset, the difference between having precious metals and not having them could be the difference between preserving your wealth and losing most of it. That's an asymmetric risk-reward profile. Limited downside, significant upside. And in uncertain times, that's exactly the kind of position you want to have. Let me share one more historical example that I think is particularly relevant. In 1980, gold reached $850 per ounce. Adjusted for inflation, that's over $3,000 in today's money. And it got there because of similar dynamics we're seeing now. Inflation, monetary instability, geopolitical tensions, loss of confidence in paper currencies. After that peak, gold entered a 20-year bear market. It fell to $250 by 2000, and everyone who bought at the top felt foolish. But here's what's important. The people who bought gold in the early 70s, before the big run-up, did extraordinarily well. They bought at $40 and sold at $800, a 20-fold return. The lesson isn't about timing the exact top. It's about recognizing the major trend early and positioning accordingly. We're in the early stages of what could be a similar move. Gold has broken out to new highs. Silver is showing strength. Central banks are accumulating. The fundamentals are aligned. The people who recognize this now and take action are the ones who will look back in a few years and be glad they did. Now, I want to be clear about something. I'm not telling you to put your entire net worth into precious metals. That would be reckless. Diversification matters. Balance matters. Risk management matters. But I am saying that if you don't have any exposure to gold and silver right now, you're taking a significant risk. You're betting that the current monetary system will continue functioning smoothly, despite all the evidence suggesting otherwise. And that's a bet that more and more sophisticated investors are unwilling to make. The next 30 days will bring new information, new data points, new developments. Pay attention to central bank actions, watch the dollar index, monitor geopolitical tensions, track physical demand indicators. All of these pieces fit together to form a picture. And right now, that picture suggests we're on the verge of a significant move higher in precious metals. The question you need to ask yourself is simple. Am I prepared for what's coming? If the answer is no, you still have time. But that window is closing. Once the move starts in earnest, prices will gap higher, premiums will spike, availability will become an issue, and the opportunity to position yourself advantageously will have passed. This isn't about fear. It's about recognizing reality and responding rationally. The global monetary system is changing, the evidence is overwhelming, and the people who adapt to that change will fare much better than those who ignore it. So take some time over the next few days to really think about your financial situation. Look at your portfolio. Consider your exposure to monetary risk. And ask yourself if you're positioned for the world as it is, not as it was, because the world is changing, fast, and the next 30 days could determine whether you're on the right side of that change or the wrong side. The choice is yours, but make it soon, because time is running out.